Hi, I'm Siu-Ling Hui with part 4 of a video series about how your financials can help you manage and drive business success. In this video, we'll look at how some common business taxes affect your financials and your finances. In the earlier videos in this series, we assumed that the income tax rate for the business is 0. In other words, there was no tax and profit before tax was equal to profit after tax. But the reality is businesses are subject to income tax unless they're making a loss, as well as a raft of other types of taxes. So now let's look at the effect of corporate income tax and some other common business taxes. Businesses are subject to a variety of taxes which are imposed by federal, state, and local authorities. The tax regimes vary from country to country. Within each country, different states and cities have their own business tax regimes as well. Corporate income tax is the business equivalent of personal income tax. It's based on the earnings of your business, the profit that your business makes. Then there are consumption taxes. These taxes apply at the individual transaction level, when you buy or sell something. With these types of taxes, your business is effectively collecting taxes for the government. A common type of consumption tax in many countries is VAT, or value-added tax, which is also referred to as GST, or goods and services tax. The term depends on which country you are in. Another type of consumption tax is sales tax. This works quite differently from the VAT or GST regimes. Then there are payroll-related taxes, in particular withholding tax on salaries and wages that you pay your employees. You have to withhold the right amount of income tax from wages or salaries and hand it over to the tax office. In effect, your business is playing tax collector for the government again, but this time you are collecting personal income tax. This is by no means a comprehensive list of business taxes, and this video is certainly not intended to be tax advice in any way, shape, or form. I strongly recommend that you speak to your accountant to make sure that you know what your business tax obligations are and make sure you comply with the various tax law that applies to your business. Let's start with income tax. We'll assume a corporate tax rate of 30%. That rate is applied to your profit before tax. One thing you should be aware of is that profit before tax for accounting purposes is not necessarily the same as profit before tax for tax purposes. During the course of the year, we use the accounting profit to estimate the amount of income tax that the business will have to pay. Your accountant will do all the necessary adjustments to work out the taxable profit when he or she prepares your annual tax returns. Let's assume that this month sales are $6,000 and we'll stay with the 80-20 split of credit and cash sales. You get in $2,300 from your debtors and you purchase $3,000 of widgets this month on 30-day terms. We'll leave wages at $200 for the month at this stage. So what does your profit and loss show? Profit before tax is $2,800. The income tax rate is 30%. So this means income tax expense of $840, which leaves you with net profit. That's profit after tax of $1,960. But you don't actually pay income tax on a monthly basis. Income tax is finalized at the end of each tax year and paid a few months later. Let's look at what happens to your balance sheet. The income tax on this month's earning shows up as a provision for income tax under liabilities in your balance sheet. Provision accounts are sort of like savings accounts. You are providing for the estimated income tax that you are likely to have to pay on each month's earnings. The cash hasn't gone out yet. This is just the estimated amount you owe the tax office out of this month's profit. Now let's turn to the cash flow statement. The net profit that is taken to the cash flow statement is the net profit after tax because that's the bottom line profit. The increase in provisions in the working capital section shows that this provision for tax had a positive cash flow effect on your working capital. The day that the tax is paid, you'll see a decrease in provision for income tax, which will be a cash outflow. What is effectively happening here is that you get to use money that is potentially payable to the tax office as part of your working capital. In other words, the tax office is funding your business. That's why it's part of your business liabilities, and the amount of funding will keep growing through the year. That's all well and good, but you better be sure you have the money to pay the income tax bill on the full year's earnings when it does finally become payable. Now let's take a look at an example of consumption taxes. Businesses are essentially fulfilling the role of tax collection for the tax authorities with this type of taxes. I'm going to use GST, or Goods and Services Tax, as an example. VAT is the other name for this type of consumption tax. The broad principle of how this form of consumption tax works is that you have to add the tax to the sale price of your goods and services and collect it from your customer. Your purchases will include this tax, as well as your supplier has to charge the tax on the goods and services that he or she sells to you. The difference between the GST you have collected and the GST you have paid is remitted to the tax office. If you've collected less than you've paid, then the tax office gives you a refund of the tax you've paid, net of any amount you've collected. With GST or VAT, your business only remits tax on the amount of value it has added to the goods and services it sells, hence the name value-added tax. Each country has its own rules around what items are exempt from GST or VAT, what returns have to be lodged, and the frequency of lodgement and remittance of the GST or VAT collected. Make sure you fully understand your obligations with all consumption taxes that apply to your business, regardless of whether it's GST or VAT, sales tax, or other such types of taxes. If you aren't sure, speak to your accountant. Now let's add the effect of GST to your account in month 4. I'm staying with the numbers in month 4 so you can see the difference between what happens with income tax versus a consumption tax like GST. Let's say a GST regime is brought in at the start of month 4. The GST rate is 10%. So that means sales of $6,000 have to be invoiced at $6,600 with GST added on. With your purchases of $3,000 of widgets, your supplier will actually invoice you for $3,300. Your supplier has to add the 10% GST to his or her price. Let's also assume that your business is required to file GST returns quarterly with the tax office. Now let's look at the impact of GST on your financials in month 4. First, the profit and loss. Your profit and loss numbers are all exclusive of GST. The GST that you charge and collect from your customers is not part of your income. Therefore, it is not included in your sales figures in your accounts. Remember, with this type of tax, you are collecting money for the tax office. It's not your money. Likewise, expenses do not include GST amounts either. You can get that back from the tax office. The GST amounts collected and paid show up in your balance sheet. Look at the difference between the balance sheets with and without GST. Under liabilities, there is now an item that reflects the net amount of GST payable or receivable. If the GST on your sales or other income items exceed the GST on your purchases, you will have net GST payable to the tax office. But if it's the other way around, then you'll be entitled to a refund from the tax office and you'll have a negative GST liability on the balance sheet. In other words, it's really an asset as the tax office owes you money, but tax items are usually shown in the liabilities part of the balance sheet. Your cash, debtors, and creditors all have increased as a result of the GST. The increase in cash is from the GST portion of the cash sales. You have to hand that over to the tax office at some stage, and you need to be sure that you will have enough cash in the bank when the time comes to make the payment. The debtors balance has also increased by the amount of GST. If you don't collect the money from your debtors before you have to pay the GST on your sales to the tax office, it comes out of your own cash flow. This reinforces the importance of keeping a very tight rein on your debtor collections. Let's look at what the cash flow statement shows. Look at the difference in working capital changes with and without GST. To save space, I've included the movement in net GST liabilities under provisions in the cash flow statement. Working capital used up in your business is lower by $120 because of the net effect of GST collection and payments. These all feed through in the changes in balances of debtors, creditors, and provisions. In this simple example, we know that the $120 increased cash flow comes from the GST you collected from your cash sales this month. You haven't paid that GST collected to the tax office yet. So your business has effectively got some additional short-term working capital funding from the tax office over and above the provision for income tax. But there's a very important difference between provision for income tax and the GST liabilities. We'll discuss that after we cover another type of tax which you also collect for the tax office, and that's the withholding tax on salaries and wages. In most countries, the tax office requires employers to deduct the personal income tax from your employee's pay packet. Your business has to remit this amount, called the withholding tax on salaries and wages, to the tax office. The tax office provides a schedule of the amounts to be withheld at different salary or wage levels. Make sure you get this schedule every year and update your payroll systems with the applicable rates. This withholding tax doesn't affect your profit and loss. You still charge the gross wage or salary as expenses. The difference is with the timing of the cash flows. On payday, you pay your employees their wage or salary after deducting the personal income tax that applies to their pay levels. Your business is required to hand over the amount deducted from personal tax to the tax office at the prescribed lodgement times. Make sure you know when you have to do this. Let's have a look at the effect of withholding tax on your financials in month 5. Here are some assumptions about your business in month 5. Your sales are continuing to grow rapidly and your assistant is working more hours. So your monthly wage expense is now $400 instead of the $200 per month you've been paying so far. With this higher pay bracket, withholding tax of $12 applies to his or her monthly pay. On payday, you pay your employee $388. That's the $400 wage minus the withholding tax that you are required to deduct from his or her paycheck. We'll assume that your business is required to remit a withholding tax on salaries and wages every calendar quarter. Now let's look at the month 5 financials. Sales for May are up to $9,000. The gross amount of wages in the profit and loss is $400. The withholding tax isn't separated out for the purposes of the profit and loss. Your wages bill is $400. You are just paying it to two different parties, $388 to your employee, $12 to the tax office. The effect of this split of the wage expense between what goes to your employee and what goes to the tax office shows up in your balance sheet and cash flow statement. On your balance sheet, the personal income tax that you've deducted from your employee's paycheck but haven't paid to the tax office yet shows up as a liability called withholding tax. You still have the $12 withheld in your bank account. In your cash flow statement, this $12 is included in the line I've called increase in provisions. As you can see, this buildup of taxes collected on behalf of the tax office helps with working capital funding. But this won't last forever, as this money must be paid to the tax office eventually. It's very important that your business manages its tax liabilities properly. With consumption taxes like VAT, GST, and sales tax, and payroll-related taxes like withholding taxes, your business is legally obliged to collect these taxes for the government. The money collected is not your money. Even if you're making a loss and you don't have to pay income tax, you must still pay all these other types of taxes that your business has collected. With these types of taxes, you are usually required to remit the money quarterly or monthly, depending on the tax rules that apply to your business. You must ensure that you have the money to remit all these taxes to the tax office when payment is due. The tax office is not your banker. You do gain some benefit of having the money to use as part of your working capital funding for a short time, but with these types of taxes, the time frames are very short. But if you don't pay these amounts when due, the tax authorities can and will take action against your business and potentially against you personally as a director of the business. Having a tax debt that's overdue payments of taxes makes it very difficult to get financing. Banks don't like lending to businesses which have not been able to meet their tax obligations. And in times of tight credit, having a tax debt on your books will automatically disqualify you as a credit-worthy borrower. Let's do a quick recap of what we've covered in this video. Every business, regardless of where you are, has to deal with a whole raft of different taxes. Apart from federal taxes, there are also state and local taxes. Each of these types of taxes have different impact on your financials and your finances. It's vital that you understand what all your tax obligations are. Because of the complexity of taxation systems, I strongly recommend that you get professional advice as to what your business needs to do to ensure that your business is compliant across the board of federal, state, and local taxes. Be very careful when using tax money as part of your working capital funding. You must plan and manage your cash flows to ensure you have the money to pay the tax office on time. There are severe penalties for non-compliance with tax laws, and if you can't pay your taxes and run up a tax debt, you could potentially end up in the problem loan department of your existing bank, because tax debts are seen as a sign of cash flow management issues and financial stress. It will become almost impossible to get refinancing or new financing. If you want more information about business financial reviews, business planning, or about financing in general, please put your questions below in the comments or contact me through the contact page at incontextfinance.com. Master your cash flow, know your finances so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.